In late December 2008, USA Today summed up what had been a devastating year for most investors this way. The economy tanked as doubt and fear dominated. Things we never thought possible at the beginning of the year are reality today. In this week's video, we'll cover concepts to help us manage and mitigate risk during the next inevitable bear market. The examples we'll be using this week are not the market model. We're showing just a very small part of the market model. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Before we move to the bear market example in the second half of 2008, we'll cover the basic concepts of using moving averages here. We'll be using the EMA 20 on a daily, EMA 40, those are exponential moving averages, standard 50-day, and the 200-day. There's nothing particularly magical about using these. We find them to be helpful. The point is we can discern between high probability markets and lower probability markets. Regular viewers and clients know that we talk about full bore bullish looks and full bore bearish looks to help us determine and understand probabilities. If you want to understand the meaning of the term full bore, it's an automotive term, at least from my perspective, and it talks about the bore of a cylinder wall. If you bore out cylinder in your engine, a wider cylinder, at least in theory, will give you a larger displacement, which it will, and will add a little bit of horsepower. So full bore, you can think of it as full throttle or pedal to the metal. Next, we have our fastest moving average, the EMA 20 in blue, above the slower moving averages. This is the 200-day. Prices above all of them and the slopes of all of them are up, telling us that the probability of good things happening increases when we have this look. And in this case, and indeed, good things did happen. This is observable, and we can observe it before these gains. And as you might imagine, a full bore bearish look looks nothing like a full bore bullish look. Now we have our fastest moving average, the blue one on the bottom, with the 200-day here. Price, instead of being above them, is now below all of the moving averages, and the slopes of all of them are down, telling us that the probability of bad things happening increases at this point. We can observe the full bore bearish look before these sharp declines in the S&P 500 index. Since we'll be covering bear market tactics, we'll look at 2008 because it's still relatively fresh in most people's minds. We'll be covering roughly this period here in 2008 when the S&P 500 was trading at 1426 and moving all the way down to this period here in late November of 2008. This is a 47% loss, and we'll talk about how we could have mitigated, not eliminated, some of this risk. Bear markets are common events, and we will have a bear market again. And while many will tell you that 2008 was a once-in-a-lifetime event, it's really not that abnormal for the S&P 500 to drop somewhere in the order of 30 to 50%. For example, the S&P 500 dropped over 50% in the financial crisis, and it also dropped over 50% in the dot-com bust. That's hardly a once-in-a-lifetime experience. It's already happened twice in most of our lifetimes. Is it worth paying attention? What this shows you is, this is May 19th here, if you had $5 million in a buy and hold S&P 500 portfolio and you lost 47% here on November 20th, 2008, here your $5 million was worth $2.6 million. On the other end of the spectrum, if you started with $250,000 or $250,000 on May 19th here, buy and hold in the S&P 500, the 250 would have lost 117,000 and been worth 132,000, telling us that developing strategies to try to mitigate and manage through periods like this can be very, very helpful relative to our net worth. Before we bring in the moving averages, here's our reference point. We'll start here at 1426 in mid to late May of 2008. We begin at the point where the S&P 500 is trading over 1400, and you can see this is the 200-day here. The slope of that is down and price is below it, telling us that we have a negative longer-term trend. And the way you use the moving averages, this is the most important to investors. This is the least important moving average because it's the most sensitive. We can weight these moving averages based upon their importance to our time frame in our model. So before we move at all, our bias is already negative because of the slope of this line. However, you can see prices above and things are improving here. So in the real world, we're waiting to see what happens at this 200-day moving average. This could be a bullish development if price can get into this area here, especially if the 200-day moving average can turn back up. The next thing that happened on the observable evidence front was that the S&P 500, this is a daily chart, moved above the 200 on an intraday basis and then closed right on it. So we're still somewhat of in no man's land here, waiting to see what happens next. The following trading day, the S&P 500 bounced off of the 200-day. All things being equal, this is telling us to remain open-minded. We don't anticipate anything here, but what we'd like to see here from a bullish perspective is price to close above the 200-day in pink, and we'd like to see these moving averages all cross back above the 200-day and have price remain above it. But in our model, we wait for observable evidence, so we're somewhat in a hopeful but holding pattern here, and our allocation has already been cut to reflect the negative slope of the 200-day moving average, and that price is still below the 200-day, both important. As we move forward, things aren't looking so good. We've been rejected at the 200-day moving average in pink, and you can see the 200-day is starting to roll back over, and now price is below red and below blue, and the slopes are rolling over. We use this, we can ask binary and unbiased questions. Is price below the 200-day? Yes or no. Is the slope of the 200-day bullish? Yes or no. We fast forward here, we still have an indecisive look again, flat. Price above these moving averages, but below the more important 200-day. We'll keep an open mind moving forward. It's a good thing our rules don't allow us to jump the gun and forecast here because the developments are still indecisive, and now we have price below all of the moving averages again. Regular viewers know that when we see a tight cluster in these moving averages, it's telling us to get ready that a move is coming, and you can see all of the moving averages are close together here, tight, flat, and indecisive. Open mind would be the word of the day with a bearish bias because price is below a 200-day that still has a negative slope. Fast forward a few days ahead, and this is not looking so good. Look how tight the MAs are here. They're rolling over and price is below it. The slope of the 200-day is down. Price is below all of them. This is a pay attention, be careful, and you should have already reduced risk somewhat based upon all of this observable evidence. Moving through this chart on a step-by-step basis helps us because we can see the observable evidence and how things change over time. And the important thing here is, this is June 17th, 2008. We now have a full-bore bearish look. Prices below all the moving averages. The fastest moving average, blue, is on the bottom, 200 on the top. All of the slopes are negative and prices below all of them. We have this waving yellow flags June 17th, when the S&P 500 was at 1350. This look is observable before the 44% drop that took place between this level and this level. We know from our opening that a full-bore bearish look tells us here on June 17th, 2008, with the S&P 500 trading at 1350, that the probability of bad things happening has increased. A fair objection may be this is all backward looking, the future will be different. Those of you that watch our videos on a regular basis know that we've used these concepts in similar videos for 1987 and the flash crash, two of the more difficult times. The beauty of the math is the moving averages don't know the whys. They don't know why the aggregate opinion has now shifted to risk off, which is what this full-bore bearish look is telling us. It looks bearish at the dot-com bust, it looks bearish in the financial crisis, and it looks bearish during the flash crash for different fundamental reasons. But to get bearish, you always have to get to the net or aggregate interpretation of those fundamentals has now flipped to net bearish. It should be noted, and there's no question, that some examples in history are harder to deal with than others using observable evidence. But again, we've shown that the more difficult 1987 and 2010, you could have mitigated risk and managed through it using something as simple as this moving average system. But these are more difficult. A key component of what we do is this is observable at this point. We're not relying on forecasting. We don't need to forecast. We need to pay attention meticulously and adjust. Buy and hold and hope has no way of doing that. This method at least allows you to reduce risk and stay in line with the observable evidence and the market's risk-reward profile. Now we'll step through and see how the moving averages and observable evidence changed over time. If my model was based on just these moving averages, and again our market model is based upon thousands of inputs, but if this was our model, all the answers to our binary questions would be no here, telling us to reduce our allocation to risk. The probability of bad things happening increased in here, and indeed bad things are happening. No improvement. We get a little bit of a bounce here, but you can see the moving averages are telling us that this is volatility to ignore. This is a counter trend move against an established downtrend. Why is it volatility to ignore? Nothing's changed here. The answers to all the questions are still no. We do have some observable improvement, but remember earlier in the video we said that this was the most important moving average, the 200-day, and the fastest one was the least important. So this is observable evidence, but it doesn't make your model move very much if it were based only upon these moving averages. We do have two yeses now. The slope of this is up and price is above it, but still have several no's in the more heavily weighted longer-term moving averages that relate more to investing rather than trading. We're in mid-July now, and we still have nothing in the way of meaningful observable improvement. This still looks like a low probability market from a risk-reward and trend perspective. For an investor, if you reallocate or consider reallocating once a week, that's better than doing it daily, meaning some of this daily movement intra-week for the most part can be ignored. You can see here we do have some improvement again, but nothing really great. We have one yes, price is above blue. The slope of this is flat. It's not up, and still have a lot of no's here. But we would keep an open mind in the real world about what would happen next. We do have some improvement here, but we're still not checking that many substantial and significant bullish boxes. As a reference point, this is what full-bore bullish looks like 2006. Price below the 200-day. It's supposed to be above the 200-day. Slope of the 200-day down. Full bore bullish, it's supposed to be up. Price is supposed to be above all the moving averages. It is some, but these moving averages are all supposed to be above the 200-day. We really don't have a lot of the important elements of a full bore bullish look, and hence this improvement would only warrant a small incremental move, if any, back towards equities. Well, good thing our rules make sure that we don't anticipate that good things will happen. We wait for them to happen. You can see as we move forward here, we're very, very close to returning to a full bore bearish look like this, which is a low probability market. Now we've returned to more of an indecisive look here, but look, we have the tight moving averages, which tells us to be open to a move in this direction or in this direction that's sharper than anything we're seeing in here. Nothing new to report here, still indecisive and tight, but you can see these moving averages look like they're trying to roll over. Right here it's telling you still be ready for a move in either direction. Our patience here has paid off. We're back to a full bore bearish look, telling us that the probability of bad things happening has increased. A 2-day bounce here, but you can see this still looks nothing like a full bore bullish look. Nothing positive to report. We'd be in no rush based upon this observable evidence to reinvest our cash or move out of bonds. The probability of bad things happening increased here, and indeed, very bad things are happening. We've covered the entire wealth-destroying 47% drop. Looking at price alone, it's difficult to answer the question, what is a prudent allocation between growth and conservative assets? However, if we add in something as simple as the moving averages, we begin to form a basis for building a rational, unemotional, and unbiased model for making prudent investment decisions, based on evidence we have in hand, rather than relying on the countless crystal ball interpretations coming from talking heads. The next slide looks at the accuracy of forecasting, and then we close with a slide describing how do we use all this and make risk management and investment decisions. In the opening, we said this is what full bore bullish, or the odds are in our favor, looks like. During the entire 47% decline that we've covered, this really never looks anything like this. And that's something that a rational and unbiased model can track and convert into a usable investment format. This text here from the signal and the noise refers to an interesting analogy between the difficulty of weather forecasting and financial forecasting. If you'd like to read it in more detail, you can press pause on your video player. If you Google these titles shown here, you can find additional resources. This is a Short Takes, which is our blog, or a Seeking Alpha post that talks about if-then systems. How do you convert the zeros and ones into a usable and allocation-driven format? Common objections are your model never would have handled something like 1987. Well, we have a video that covers the moving averages in 1987. You can find it by Googling this title. Another common objection would be your model would not have worked during the 2010 flash crash. You can find a video covering the same moving averages that we used in today's video. The same moving averages are used here and here. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM Market Model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Ciovacco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Ciovacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified